Today, markets caught saying hello to a hard landing. Hello again, it's Martin North from Digital Finance Analytics, for the latest post covering finance and property news. This is our weekly market update, where we start in the US, across to Europe and Asia, and end in Australia, and we cover commodities and crypto on the way. And a reminder here, this show is data-rich, not shouty stupidity like so much on socials these days. And the purpose is to help me understand what is really going on at the moment, and if it helps you too, that's great. As often in September, market uncertainty rippled through markets this week, adding fuel to an already volatile period, which points to more of the same ahead. The flows of data remains mixed, and US stocks tumbled on Friday after closely watched job numbers showed labour market momentum slowing more than expected. That suggested a narrower path for the US to achieve a soft landing, defined, of course, as the Fed being able to cool inflation without badly damaging economic growth. Beyond that, investors are still grappling with a shift in Federal Reserve policy, a tight US election, and worries over stretched valuations, plus numerous geopolitical tensions, and a resetting of AI tech-related expectations to boot. So we saw an ebbing risk appetite across the markets. The S&P 500 dropped 1.7% on Friday, and it's actually lost nearly 4.3% in the past week. That's the worst monthly decline since March 2023. Meanwhile, the volatility index, the fear gauge, hit its highest level in nearly a month on Friday, while Nvidia, the poster child of this year's artificial intelligence excitement, was down over 4% and stood near its lowest level in about a month. Its valuation took an amazing $400 billion hit this week, falling along with other high-flying technology names. Tesla dropped more than 8%, Alphabet was down about 4%, and Amazon and Meta platforms each lost about 3.2%. But Broadcom, which reported results after the previous session's closing bell, dropped 10.4%, while the Philadelphia Semiconductor Index lost 4.5%, reflecting in large part Broadcom's slump. Yet, despite the recent swoon, the S&P 500 technology sector, by far the biggest group in the index, is still trading at over 28 times expected earnings, compared with its long-term average of 21.2. 10 of the 11 S&P 500 industry sectors finished lower. Real estate closed flat, but the equal weight was also flat too. The Dow had its biggest weekly drop since March 2023 at 2.9%, while the Nasdaq registered its biggest weekly drop since January 2022 at 5.8% and is now down 10.5% since it peaked on July the 1st, but then is still up 13% from the gain at the start of the calendar year. The selling wave gained momentum on Friday after August jobs data somewhat missed expectations, and after two key Fed Reserve officials separately said the time had arrived for a pivot to rate cuts, renewing some concerns that the Fed has kept rates too high for too long. Fed Governor Christopher Waller said that the time for policy patience had ended and the time for action had arrived. As of today, I believe it's important to start the rate cut process at our next meeting. Non-farm payrolls expanded by 142,000 last month. That's compared with expectations of 165,000. But the prior 2 months of gains were lowered. That's another sign that the US labour market is weakening. The adjustments to prior months' data to the downside was a critical signal. The takeaway from the range of labour market data is clear. The jobs market is cooling in a classic pattern that precedes a recession, analysts at Citi wrote. A drop in the jobless rate to 4.2% suggests an orderly labour market slowdown perhaps, and probably does not warrant a big interest rate cut from the Federal Reserve this month. But Albert Edwards, Societe Generale's bearish strategist, pointed out that the June and July payroll numbers were revised down heavily on Friday. The June numbers originally showed 206,000 jobs had been created, but have now been revised down twice to show that actually it was just 118,000 jobs created. As Edwards argues, a number that low would have shocked the market if it had been released at the time, but as of Friday, it gets relatively little attention. The Fed is expected to cut interest rates at its September the 17th, 18th meeting, but the data revived fears that months of elevated borrowing costs have already started to pressure the economy. That is a potential unwelcome development for investors after prospects of rate cuts against a background of resilient growth helped drive the S&P 500 to record highs this year. Remember, investors in Wall Street and around the world have crowded into a very small number of big tech winners, including Microsoft, Nvidia, Apple, Alphabet, Amazon, and Meta. So while concerns about the weakening US economy or a hard landing or emergency rate cut are unhelpful for markets, actually we don't need really bad news to get a major pullback in equities. Indeed, we've got a correction in the Nasdaq Composite based on little more than relatively small cuts in earnings forecasts for big tech companies, and Nvidia falling 18% after delivering pretty impressive sets of results in the second quarter just a week ago. So positioning remains extreme, therefore, and investors are complacent about the risks that a soft landing could turn into something nastier. Remember that September often brings volatility markets, but don't ignore the direction of travel. The US 2-year Treasury was at 3.654%. That's down 6.75% over the week, while the 10-year was at 3.716% and down 4.94% over the week. But wait, that means that the inversion seen for months has reversed. In fact, the shape of the yield curve has been in the spotlight over the past week, with US and European 10-year bond yields rising sharply compared to their shorter-dated peers. Central banks' rate hikes have pushed up yields on short-dated bonds, which are highly sensitive to short-term borrowing costs. Longer-dated yields have risen less sharply because investors expect rates to fall at some point in the future. That's led to a rare situation where the bond yield curve is inverted. The gap between the 2-year and 10-year Treasury yields in the US, for example, hit its deepest inversion since 1981 at the start of July. That's around 110 basis points between the two, as inflation remains stubborn and investors brace for more rate hikes. But now there is a focus back on steepening trades, bets that shorter-dated yields will fall relative to longer-dated yields. Many investors say the big rush into such wages will come when central banks look poised to cut interest rates to bolster growth. In those trades, investors buy a short-dated bond in the hope that its price will rise and the yield will fall, and short, that means bet against a longer-dated bond for the opposite reason, and they are likely to use futures contracts, which makes it easier to bet on the direction of assets. It's a typical end-of-cycle trade, said Fabio Bassi, head of international rate strategy at JP Morgan. I would expect that in the next quarter, more people will start positioning for a steepening of the yield curve. The market moves over the last week highlights the risk of curve trades. Few investors expected long-dated yields to start rising faster than short-dated yields in what's known as a bear steepening. Analysts said a key factor in the move is a growing belief that the US economy might avoid any serious downturn. That could complicate bets on a bull steepening where short-dated yields drop as interest rates fall. The US dollar index futures was up 0.08% to 101.19. Incidentally, the Bank of Canada, who became the first G7 central bank to start cutting rates, on Wednesday trimmed its key policy rate by a further 25 basis points to 4.25%. And Governor Tiff Macklem, citing weak growth, said a larger cut could be in order if the economy needs a boost. The bank held its benchmark rate at a 2-decade high of 5% for a year until June, when it started the easing cycle. Wednesday marked the third consecutive cut, with the bank citing continued easing in broad inflationary pressures. It's worth noting the trajectory of employment, though, as new job creation fell and the unemployment rate rose to 6.6%. Australia, please note. Gold futures for December delivery were down 0.71% to $2,525 a troy ounce. And elsewhere in commodities trading, crude oil for delivery in October fell 1.5% to $67.67 a barrel, while the November Brent crude contract fell 1.68% to trade at $71.06. Concerns over the demand for oil came just a day after OPEC Plus said it had agreed to postpone a planned increase in oil production for October and November. And geopolitical tensions ratcheted up on Friday after the US and Europe said that they were working on sanctions to impose on Iran after Tehran sent missiles to Russia. The US had previously warned Iran about transferring missiles to Russia, saying it would represent a major escalation in Iran's support of Russia's war against Ukraine. Now, in Europe, UK's main stock index ended lower on Friday, dragged down by personal goods and automobile shares. The blue chip index, the FTSE 100, fell 0.7%, marking its sixth straight day of declines. It's lost 2.5% for the week. That's the steepest weekly loss since mid-January. The domestically focused mid-cap FTSE 250 dropped 1.3%, while on a weekly basis, the index clocked its biggest fall in 6 weeks, down 2.8%. The personal good index tumbled 3.7% as the top sectoral decliner, trading at its lowest level since December 2009, following a 5.2% sell-off in luxury retailer Burberry. The index is also the biggest loser on a weekly basis, off 8.2%. Meanwhile, data showed that British house prices rose last month at the fastest annual pace since late 2022, while a report showed the nation needs to add an additional £1 trillion in investment in the next decade to grow the economy. So how's that going to work? I have no idea. The benchmark European stock 600 was also down a more severe 3.52% this week and down 1% on Friday, with the technology, basic materials and energy sectors the biggest drag, all falling over 2%. European shares fell for a fifth straight session on Friday in their worst day since August, as all major country indices fell around 1%. The DAX in Germany dropped 1.6% to a 2-week low, after data showed that the country's industrial production fell by 2.4% in July, compared with analysts' predictions of just a 0.3% drop, and the CAC 40 in France also fell to 7,352. Also on the data front, the Eurozone GDP growth was revised to 0.2% for the second quarter from an earlier estimate of 0.3%. And next week, the European Central Bank is widely expected to ease rates by 25 basis points. European markets, however, are likely to take their cues from overseas, with US inflation data expected to be the biggest mover. In fact, among individual stocks, Volvo cars dropped 5.7%. The Swedish automaker slashed its margin and revenue ambitions for a second time in a year on Thursday at its capital market day. And in post, jumped 11.7% to the top of the stock 600 as it reported a 29% surge in second quarter earnings. The euro-US dollar was unchanged at 1.1085. In Asia, Japan stocks were lower, and at the close in Tokyo, the Nikkei 225 lost 0.62% and was down 5.76% across the week, while the Topix was down 4.25% across the week. The Nikkei Volatility Index, which measures the implied volatility of the Nikkei 225 options, was up 29.67% to 2705, and the Japan US dollar fell 0.77% to 142.27. Tensions between China and Japan escalated as China is threatening severe economic consequences if Japan further tightens restrictions on sales and servicing of chip-making equipment to Chinese firms. It adds complexity to the efforts led by the US to limit China's access to advanced technology and could have significant implications for the semiconductor industry. Accordingly, high-level Chinese officials have conveyed their stance in meetings with Japanese officials. Toyota Motor, a key player in Japan's chip policy, has privately expressed concerns to Tokyo about potential Chinese retaliation that could hinder Japanese access to vital minerals necessary for car manufacturing. The US has been actively encouraging Japan to implement further restrictions on companies like Tokyo Electron from selling advanced chip-making tools to China. This is part of a broader campaign to curb China's advancements in the semiconductor sector in response to China's export restrictions on materials such as gallium, germanium, and graphite last year. US and Japanese officials have been strategizing to ensure a reliable supply of those critical minerals. The Shanghai Composite was down 0.81% on the day, while the Shanghai Shenzhen CSI 300 fell the same amount. The Hang Seng in Hong Kong was flat. Indian stocks were lower after the close on Friday as losses in the public sector undertakings, oil and gas and banking sectors led shares lower. At the close, the Nifty 50 declined 1.17%. The best performers on the session was Beige Finance, which rose 0.97%. Asian Paints added 0.87%, and JSW Steel was up 0.6%. The worst performer in the session was State Bank of India, which fell 4.26% at the close. And the Indian VIX, which measures the implied volatility of the Nifty 50 options, was up 6.49% to 1513. In Australia, a sharp rally in bank stocks helped push the Australian share market higher on Friday. The benchmark ASX 200 added 0.4% to 8,013 at the closing bell, with 8 out of the 11 sectors in the green. The All Ords rose 0.3%. That's despite the index sealing a weekly loss of 1%, the first weekly decline in 4 weeks. The financial sector was the best performing, climbing 1.5%. The Big Four all rose: Commonwealth Bank by 1.5% to 143.47, Westpac by 1.7% to $32.10, ANZ by 1.7% to $31.79, and National Australia Bank by 1.4% to $39.05. The rally in banks came ahead of those US employment data points, of course. In commodities, iron ore futures extended their slump towards $90 a ton in Singapore. Oil fluctuated and gold edged back above the $25,000 an ounce mark. The materials sector tracked the steel-making mineral, down 0.9%. BHP fell 1.2% to $38.45. Rio Tinto dropped 0.1% to $107.02. And Fortescue Metals lost 0.1% to $16.12. ASX-listed dental chain Pacific Smiles dropped 1.4% to $1.76 after announcing that the chief executive is stepping down. He'll serve a 6-month notice period, and the board will commence a recruitment process for his replacement. Woodside Energy sold $2 billion worth of bonds in the US markets overnight to be used partly to fund the $2.35 billion acquisition of a clean ammonia project in Texas and the $900 million purchase of a prospective LNG export terminal in Louisiana. Shares were down 3.9% to $24.02, tracking a lower crude oil price and touching an 80-month low. Also within the energy sector, Santos dropped 1.4% to $6.92 and Ampol slid 1% to $28.48. The latest 0.2% June quarter GDP figure released this past week means the economy is growing at an annual rate of just 1%, down from an average of 2.7% over the past 20 years. That's the slowest rate of growth since the 1990s recession, excluding the pandemic, and has brought into focus the tensions between the RBA and the Treasury, as I discussed with Tarek Brooker yesterday, as the burnout economy grinds on. To recap, earlier last week, Chalmers appeared to preemptively blame the RBA for the worryingly low economic growth figures to be announced on Wednesday. The 13 rate rises since May 2022 and all this global uncertainty, Chalmers said, were smashing the economy. Actually, of course, he's more about narrative, i.e. politics, than policy. Chalmers' words sparked a firestorm that has raged in economic circles at least all week. And on Friday, former Labour Treasurer Wayne Swan, Chalmers' old boss, poured more petrol on the blaze. The man Euromoney magazine once described as the world's best finance minister for his handling of the global financial crisis claimed that the RBA was being dogmatic rather than rational in setting interest rates. While Chalmers says his job is to tell it like it is, to acknowledge the economy is slowing considerably and what we're doing about it, his efforts to level with the public doesn't seem to include telling them that high interest rates are intended to slow demand, but still inflationary and partly fueled by public spending. Bullock made it plain in a speech on Thursday that crushing inflation remains her top priority because the lasting damage it does to every Australian is even worse than a slowing economy. High rates are worth achieving that, she stressed. Core inflation has stubbornly remained unchanged since December, even after keeping rates on hold at a 12-year high for months. It is not forecast to return to its normal level of 2 to 3% until 2026. The problem is the government can't wait that long with an election expected around April. Dr. Chalmers requires a narrative that shows Labour is serious about the cost of living pain that voters face now. He says Australians have been spared from worse because the Albanese government has propped up the economy by spending an equal record 11.8% of GDP in the June quarter. The splurge matches early pandemic era levels as subsidies for childcare and aged care rose. The National Disability Insurance Scheme continued expanding at 20% a year, and big public sector pay rises flowed through the system. And yet this spending will make little difference to productivity, and it will worsen inflation, injecting more demand into an economy that hasn't enough capacity to meet it spills over into higher prices. That in turn makes Ms. Bullock's job of controlling inflation harder. To draw attention when you're probably 2/3 of the problem is a little problematic, said former RBA board member Warwick McKibben. Opening up the spending taps, as the government is now doing and may continue to do as the election gets closer, also serves as a distraction from a more difficult conversation about how to make growth non-inflationary and sustainable, which is to lift productivity and deliver more goods and services for the labour and capital invested. But that means creating a tax system that drives the incentives to invest and to work, and workplaces that are flexible and efficient. That demands the kind of microeconomic reform programs which Ms. Bullock's predecessor Glenn Stevens and Phil Lowe frequently lamented. Coalition Labour governments have for 2 decades found it easier to shirk on that one. So if there's a lesson from this week, it is that Dr. Chalmers needs to support the institution he's helped to shape. The RBA works through credibility. People have to believe it will act on inflation and adjust their expectations accordingly. Don't play politics with the RBA, Dr. Chalmers. Finally, in crypto, as it gets closer to 55,000 US, the price of Bitcoin is still showing signs of weakness, and the decline to 52,000 is looking more and more likely. A bearish attitude has been evident in recent market data, especially some institutional investors seem to have been withdrawing their money from exchange-traded funds related to Bitcoin. We continue to see significant net withdrawals from those spot ETFs, and the market's declining institutional interest is reflected in the total net assets of Bitcoin spot ETFs, which currently stands at around 50.7 billion US. The asset is presently trading below its 200-day moving average, indicating a medium to long-term bearish trend. The price is currently within the declining price channel, and this downward trajectory is anticipated to continue unless there's a notable change in the market sentiment. The amount of 52,000 US, which is the bottom of the declining channel, is the next important level to keep an eye on. An even more marked sell-off may occur if the price breaks below that level and keeps falling. The bearish view is further supported by decreasing volumes, which indicates that bulls do not have enough strength to drive the price higher at this point. A dearth of supportive market catalysts and international overflows seem to be the primary causes of the immediate selling pressure seen on Bitcoin. On the horizon, 52,000 is going to be a critical level to keep an eye on. Investors should brace themselves for additional declines, but I think you can extend that more widely too. We are going to see further volatility and further falls in the markets through September and October as some of these interest rate questions get sorted out. The bottom line is markets are still way overvalued and will continue to fall, especially as the AI question writ large. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.